All right. Well, welcome everybody and Happy New Year. This introduction to what I'm going to be talking about today, the new indicators we have, the new setups. It was coincidental that it happened at the beginning of the year. We weren't holding off on it, but I did get the opportunity during our break to finish up some of the testing that I have been doing. For those of you, a lot of you already know me and know what we do here. For those of you that don't know me, the process of developing first a theory, then testing that theory, then developing indicators for that theory, then developing trade setups with those indicators, and then testing to try to disprove the theory using the indicators is a pretty long and drawn out process. It is not what most people believe it is. When you make your living at day trading, you don't have the luxury of just saying, hey, I think I'll try this because this seems like a good idea. Um, you don't ever want to, put real money on some hunch that you have or something you think might be a good idea, or test something just a few times and go, hey, this looks pretty good. I'm going to try it for a while and see how it works out. That's a real quick way to go broke. Um, so I've learned that it's important to put in a lot of work, and the crux of the work is trying to prove that a theory that you have is wrong or disprove a theory. It's real easy to have a theory about trading and then to prove that theory right. Okay, you can always prove it right. But if you attempt to prove it wrong and you can't, then you might have something. And so that's why many of you know I've been working on this climatic volume for some time. In fact, I did this similar event to what we're doing today about 6 months ago, because I had been working on climactic volume and I thought it would be very interesting for other people to know what I was working on. Subsequently developed a climactic volume indicator for us to use in the trade room, and now have finally been able to or unable to disprove a theory I had about using climactic volume in an actual trade setup. So we're going to talk about that. So welcome everybody, happy new year, and let's move on. All right, so the first thing is all of the disclosures. Basically, trading is dangerous. You're probably going to lose a lot of money. Don't believe anything I say or do. This is only for educational purposes. You know, you guys have already you've seen all of this. Okay. Um, what I what I'm going to be talking about today is kind of an extension of a webinar that I had done some time ago, on volume spread analysis. And if you want to find that, just go to YouTube and go to the search and type in volume spread analysis, and you'll see uh, our video come up. It's actually got over 105,000 views on it now. So it's pretty well received. It's got the most views of any on YouTube. So if you want to see that video and see what what I talked about and what this is an extension of, you can go ahead and go over there and look at that. While you're there, please go ahead and subscribe. And once you've subscribed, go ahead and next to the subscribe button is a bell. If you click on that, then whenever we upload more content, more information to our YouTube site, you'll get an alert to make sure that you're up to date on everything that we're doing. Okay. All right. And I'm going to tell you this, and then I'm going to tell you again. I'm going to give you some general information about what we're doing with these new indicators and why they work. I'm going to do all of that today. I'm going to what they look like, why they work, what they're based on, all of that. Okay. Saturday, I'm going to tell you how to take all of that information and make a trade setup out of it. All right. So that's this Saturday at 10. Connor's got a registration link for you right there in the chat. If you're watching this on video, there's the registration on the right here in blue. If you want to go there to register, he probably will also put it down in the description down in the bottom of the below the video right here. Okay. So that's at this Saturday, 11 a.m. Eastern time. All right, we're going to talk about the pullback trades that we trade, the new indicators, and I'm going to show you how easy it is to apply these indicators to create trade setups. All right. So our agenda today. Yeah, we'll have everything recorded for Saturday. Yep. And as long as you're here and as long as you register, Gary, you'll get the recording Saturday. Okay. So today, briefly, we're going to go through this, and I'm going to try to keep. This is my New Year's resolution for doing events. I'm going to try to shorten them all. Instead of an hour, I'm going to try to shorten them all to 45 minutes. I think I can get said what I need to say in 45 minutes and not keep you guys so long. Okay, so we're going to talk about volume and what it is, why it's important to traders, the Wyckoff or Wyckoff. I've been saying Wyckoff for I don't know how many years, and somebody corrected me last time. I said it's Wyckoff. I actually did a search on it. I think it's interchangeable. You can say it either way. But doing the Wyckoff price cycle, talk about climatic volume phase of the price cycle, what causes climatic volume, and then what the birth of our high probability trading system, and why the system works almost every time. Okay, and then we're going to talk about the new indicators, and then I have a special offer for you at the end. Okay, so we're going to knock all that out in the next 40 minutes. All right, volume. You know, I'm going to do some elementary stuff here because a lot of people come into trading without a full understanding of what's actually going on. You know, trading to them is just seeing price move up and down charts, and you want to buy when price is low and sell when price is high. And that's pretty much all the understanding a lot of people come into trading with. And they try to trade without actually having an understanding of what it is that's going on. What I'm going to be talking about and what we're going to be talking about Saturday is all about volume. Okay? We need to understand not just what it is, but the logic of what it is and what goes into it and why it's happening the way it's happening and why we have volume and why we don't have volume and things like that. All right. So volume is actually the number of shares or contracts that are actually traded. Okay. These aren't orders that are just sitting and waiting. Okay. These are orders that are being processed, which means that there's a buyer and there's a seller for each trade. Okay, so that's a transaction. There's one buyer and one seller, so there's two people that create one transaction. Okay, I do get that question a lot. Is volume buying and selling, is that two separate things? No, that's one buy, one sell. Okay, that's one transaction. And that's when the buyers and sellers agree to make a transaction. And that's what the exchanges do for us. We don't have to actually meet the person that is, if we want to buy something, we don't have to actually meet the seller. The exchanges give us a central location to do that, and they make it a lot easier for us to do that. Okay, so if you have something to sell, you just throw it up to the exchange. If you have something you want to buy, you go to the exchange to see if they have it. Okay. So this is how volume is measured. And this is how we typically measure volume on our trading charts. Okay, so we're going to have a histogram down at the bottom, and we're going to look at the size of the bars to help us understand how much volume went into creating that bar in the charts. Okay, volume is one of the oldest and most used technical indicators in trading. Typically, it's used to help assess the health of the prevailing trend. It makes sense that we track volume, since without it, We don't have anything to do. Order analysis can be tricky. You know, the orders that are the resting orders that are sitting on your trading dome on the sides, the level 2 orders or the book orders. Those can be tricky if you're trying to use those to place trades, because there's a lot of games that can be played, a lot of misinformation, and the information you're using can be very unreliable, because somebody can put on and take off orders very quickly. And it's called jazzing the markets. So they tend to jazz the markets a bit, and so that's pretty unreliable information. The information we want is actual transactions. That's the volume. That's where volume comes from. Real volume. Okay, we're talking about real volume. Actual transactions is what we're talking about. All right. So we've got these transactions, and these transactions will build these volume bars. Okay, so this is how we typically use volume. People want to say, okay, well, there's a lot of volume, so that must tell me that the prevailing trend is very healthy, whether it's an uptrend or a downtrend. So you're going to use that volume a lot of times to say, okay, well, since that trend seems very healthy, because there's a lot of volume, I think I may want to get into that trend. Okay, so this is typical. All right, this is why so many of us use volume. So to create one bar on the chart, we're going to measure the number of transactions between one buyer and one seller, see how many transactions that took to create that bar, whether that bar is a tick bar, whether it's a volume bar, whether it's a time-based bar, whether it's whatever kind of bar. We can figure out how much volume was inside of each bar. Okay, and this is how we're going to start figuring out where the buying and selling pressures are. The analysis of volume gives us a general picture of the buying and selling pressures. So even though volume is considered a technical analysis indicator, even most fundamental investors also take note for the same reasons that day traders do. We don't have volume, then we don't have anybody to trade with, right? We don't have anybody to buy and sell with. Now, remember, the markets are an auction, right? Everybody understands. Everybody knows that, right? I hope. The markets are an auction. So if you picture going to an auction where you're buying an antique table or something, and there's only one of those antique tables, and a lot of people want it, what's going to happen to price while some people are bidding on that antique table? Now there's only one, so it's very rare. So people are going to start bidding it up because there's only one of those. Now on this other side of that, what about this big stack of chairs over here? Nobody really wants chairs, but there's a bunch of them over there. How much do you think you can get for each chair? Probably not much. Okay, that's exactly what's going on in the markets. Okay, we need people to buy and sell with. So when we have volume, we have people to buy and sell with. Okay, that's called liquidity. The higher the volume, the assumption is that the instrument will also be more liquid and easier to trade when it comes time to get out of a trade. So if you bought an asset and you want to hold it for a particular period of time or until it gets to a certain price, and then you want to sell it, we've got to have some volume and people willing to buy it from you. Okay? So this is all very important to understand what it is that we're going to be talking about as it relates to our new trading indicators and our new setup. I'm not just talking about this for general education, although I know a lot of you may not know some of this stuff. All right, so the Wyckoff price cycle. Wyckoff, Richard Wyckoff, or Wyckoff. I'll probably always have to correct myself on that because I've been saying Wyckoff so long. He's a real successful trader about 100 years ago or more. I can't remember. Back in the early 1900s. And he was somewhat of a market authority. He was the editor of the Wall Street Magazine, editor of different stock market techniques, or Technique Magazine. And according to Wyckoff, the market can be understood and anticipated through detailed analysis of supply and demand, which can be ascertained from studying price action, volume, and time. Okay? For those of you that like to use Renko charts or some other fancy kind of hybrid chart or something, I don't understand it. I don't understand why you want to do it. I don't understand how you can be successful at it, because the study of time is so essential in trading. And that's what Wyckoff also believes. And remember, this is nothing but auctions, right? And so you've got to remember what's going on here. Got to have volume. Now, for those of you that haven't seen the volume spread analysis webinar, the volume spread analysis is a good way to understand how the concepts of supply and demand influence price. Okay, it's about spotting the imbalances between buyers and sellers by looking at prices and volumes. Okay, through volume analysis, you can know if the market makers are buying or selling and take advantage of their positions. All right. So the first thing we have in the price cycle is the accumulation phase, okay, where there's more supply than there is demand, okay? So where the demand is, what is that? I got that backwards, don't I? Where the demand is high and the supply is low. So this is an accumulation phase. This is likely when price is going to be oversold. All right. Now, what that looks like to us is price is just channeling. Okay. These guys, the market makers, are very slowly buying up the available assets at this oversold price. Then there's going to be a markup phase. The markup phase is the demand is increasing, which is lowering the supply because the supply is being bought up. So the down here, the supply is being bought up. The demand is going to increase because of the lower supply. All right. So that creates a markup phase. The distribution phase is preparation for a markdown. All right. The distribution phase is where the big money that we're buying up down here starts selling off up here. Now, this is also a trap, and this is where we all get trapped, all right, because we believe that sudden distribution is going to be the push or the continuation of a trend. Exactly. It's going to be the continuation. So many of us wait to confirm the existence of this trend before jumping in, right? We don't want to jump in down here. I mean, we'd like to know when this is, but nobody really knows. So you're going to wait for the existence to figure it out, and then you're going to, okay, yeah, we have a trend, I'm jumping in, and there goes the markdown phase. Okay, so this is the Wyckoff price cycle. But here's the thing. It's a nice, when Wyckoff was a trader, it was you can think of it as a nice smooth curve. But in actuality, it's going to look more like, this jagged up and down, up and down, up and down, because price is always moving, right? As long as people are placing market orders, price is moving. And so even though it's drawn and we think of it like this nice smooth curve, it's actually up and down, 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 up and down. Okay. So we have the accumulation phase is going to look more like this. The markups like this. Distribution looks a lot like accumulation, doesn't it? It's hard for us to know the difference, us retail traders. What we know and what everybody pretty much knows in trading is when it's choppy like this, don't trade. Okay? You just don't trade. Let the market makers do their thing. And then when we get some volatility, now it's time for us to do our thing. Okay, so nobody really likes to trade in this choppy type markets. So this is technically what the Wyckoff price cycle is going to look like nowadays, except for something is missing. There's one thing that's missing from this. Anybody know what that is? Back in the 1900s, things have this was high tech right here. This was the technology right here. They felt like they had a real insight into the markets and what the big boys were doing by reading the ticker tape. Okay, things have kind of changed just a little since then, don't you think? So now we've got these supercomputers and the internet sitting inside the exchanges or next door to the exchanges, where when trades were made in minutes, hours, and days before, I started trading. I had to pick up the phone and call my broker when I wanted to place a trade. There's none of that anymore. Well, sure, you can do it, but that's not how it works anymore. And it's getting faster and faster and faster to where we're now talking milliseconds. Markets move in milliseconds. These supercomputers are placing trades in milliseconds. Well, don't you think that's given the smart money yet another advantage? They're the ones that can afford this. So the smart money has added a phase to the Wyckoff price cycle. The smart money, of course, we have the accumulation, the markup, the distribution phase, and the markdown phase. But between distribution and markdown, that's where we have the climactic volume. That's what we're looking for. That is a big tell on when something is about to change. Okay? So let's look at this is let's typical chart, all right? So we have our areas of accumulation down here, right? Then we have our distribution phase. Then we have our climactic volume just before the big markdown, all right? So it's a common misconception that climatic volume in the direction of trend is considered to be a sign of the continuation of that trend. It's actually the opposite. Climactic volume indicates panic buying or selling. Okay, a strong move higher, an explosion in volume indicates that buyers are buying to avoid missing further price appreciation. Okay, how many of you have done that? You see price taking off and it feels like, oh man, everybody else is in this. I'm missing out. They must know something I don't know. I got to get in this. And if you have never done that before, you're lying. Because we've all done it. Yeah, sure. We've all done it. And this is where we amateurs get caught and where the professionals take advantage. And guess what? We don't learn. We don't learn anything. We keep falling for it. Now, many of you, most of you, I did, I always thought that big moves required big volume, right? Now, sometimes that's true, but it's not necessarily required, all right? So, let's look at climactic volume. On this bar up here, we're saying that there's climactic volume in this bar. And in fact, this is what our new climactic volume indicator looks like. When we have climactic volume, we print a box around that bar. At the time that we read that we have climactic volume. So how are we doing that? So you'll notice this volume histogram down here, and this is just transactions, right? This is simply transactions, or number of transactions. All right. So what we're going to do on every single bar is measure back X number of bars. Okay, this is what we're putting in our parameters in our indicator. There's a parameter for the look back. So we're going to look back whatever this is, and we're going to take the average of all of these bars. All right, and if that average is less than 200 to 300% of the volume in this bar, then we have climactic volume. And again, inside our indicator, you have the ability to adjust whether you want 200, 300, 400, 150, whatever you want to call climactic volume. But typically, what we know as climactic volume is at least 200% or more. Okay? So you'll notice here that we have this huge volume bar here after all these bars where we have climactic volume. Now look at the size of this bar. This is a pretty good sized bar, but so is this. So it doesn't necessarily mean that the volatility or the size of this bar is going to be climactic volume. In fact, you can see that the volume is substantially lower than this bar here. So this would not necessarily be called climactic volume. All right, it has to be a percentage over the look back period. All right, it's very important. A lot of people think that if price moves a long way, that's climactic volume. Or if price doesn't move very far, there is no climactic volume. That's not true at all. All right, it's all relative. All right, so we have climactic volume here. All right, so now you think you got this? Let's start trading some climactic volume, right? You're ready? Not just yet. Got some more to cover before we start trading it. All right, it's coming though. All right, so we now know that that bar is a climactic volume bar. How did that happen? What do we need to know about that bar to know if it's climactic volume? What's important to know so that you can be ready to take advantage of the edge that we take advantage of in our trading? What type of trader is causing this? Can anybody tell me what type of trader? And whether it's generally going to be somebody who's got enough, I don't know, money behind them to be able to manipulate the markets in such a way that they can move price. But what type of trader would that be? You better get this right, Christopher. Well, yeah, it's HFTs, because the HFTs are the ones that can move fast enough. All right, so it's the type of trader. HFTs are high frequency traders, and they generally are going to have algorithms based on this type of trading. Momentum traders. Anybody ever heard of momentum traders? So momentum traders, we've all heard buy low, sell high, right? Buy low, sell high. That's what we're all supposed to think in trading, that's the ultimate goal, buy low, sell high. Momentum traders say, no, there's still money to be made if I buy high, sell higher. Okay, and it's quite interesting to see these guys work. Momentum traders are the ones that are going to be pushing this market. Momentum traders they're kind of chasing the big moves, but the good ones are creating the big moves, Bill. Okay? So here, it's all relative, all right? So let's look at the momentum traders. All right, so we have a trend here, right? We have a nice upward trend that's personally for me extremely difficult to trade because I get too emotional trying to trade a trend like that. But we have a nice upward bias here. So we're looking at these areas where price starts kind of channeling. Arby, if you want to watch it on a video, why don't you just check out and then watch it on the video on YouTube. There's a lot to learn here, and it may be just a bit too elementary for you, but it's pretty valuable for a lot of people here. All right, so price is channeling, and we've got accumulation and distribution going on here. And at each point after the accumulation and distribution, we see that price breaks out of these channels. Okay, there's these breakout periods. This is when people start thinking, uh-oh, there's a breakout, price is going higher, I need to jump in this as quickly as possible. Okay, now we're breaking out of these trends, and let me show you what's going on here. So first, price is channeling, right? Could be low interest, could be area of accumulation or distribution. We don't really know. We just know that price is channeling. Number two, price breaks out of a channel and buying sentiment starts to increase with with a sudden bidding up in price. Okay. Now, this may be us retail traders. It may be programmatic. We don't always know, but we do know price is starting to get bid up. We also know that the momentum traders are looking for this breakout because this is when they want to trigger this. Okay, they want to jump in and buy up as much as they can, as fast as they can down here, and then sell it off up here as fast as they can, which is why they need the supercomputers. All right, so momentum traders get triggered to buy up as much as they can, causing a sudden shortage. But what they're doing is they're taking advantage of the people that are jumping in at the last minute, trying not to get caught flat-footed. All right, like I said, we've all done it. But up at that price, there's really no more buyers left. Buyers start becoming exhausted. Momentum traders dump everything as fast as they can. They overwhelm the market with supply, and they drive the price down. And then they do it again. And then they do it again. Why? Because we're sheep. We're sheep, and we'll keep doing it over and over and over again. We get emotional. We're not machines. So I started thinking, if this is happening as regular, just look at a chart. You can see it happening on any chart. If this is happening and we know it's happening, all we got to do is figure out what's going on just before this happens. Right? Because this is what always happens after breakout of a channel, push up, pull back. Okay? That's the markdown phase. So I had this idea. So I'm thinking, all right, so we have these breakouts. We've got these momentum people buying and selling to where price finally gets at or overvalued. So I looked at a lot of occurrences of this. I mean, probably not millions, but thousands. And so we look at this, and then I figured out I can anticipate that pullback now with a high degree of probability based on the information that's going on in the markets, based on the prior bars just before it. All right. So what we have after this analysis, I found that we have a lot of trading opportunities, and in fact, that's why I continued looking at the climactic volume and the other indicator I created for using for that trade setup, is because I'm always looking for a better, more efficient way to trade what we trade, to find more and more opportunities doing the same thing. I don't want to change it because what we've been doing has been working for 10 years, and I don't want to change it, but I'm always looking to get better. So we've got the momentum traders creating an unnatural increase in buying sentiment. All right, they're going to buy down here, they're going to sell here. Then we have what we call the freight trading effect, where the retailers are us little guys are jumping in and causing price to push up a little bit until total exhaustion sets in, and then down price goes. All right. This is what it looks like for us. All right. Momentum traders have caused an unnatural increase in the buying sentiment. We have a strong increase over the previous bars. Buyers have bid up, have bought up most of the available assets, which forces prices higher, and there's no more willing buyers up here, and price level has become exhausted. So this is what that looks like. This is a speed tick, and we'll talk about this on Saturday. This is also one of our new indicators here, and I'll talk about that a little bit in a minute, and then more on Saturday. So that's what all of that looks like to us. We make it real easy to see. All right, so now you're ready to start trading climactic volume. All right, so I'm going to show you these new indicators, but I wanted to remind you about Saturday. Connor, if you look up in the chat, you'll see that there is a registration page there. So we're going to talk about the new indicators and the new opportunities that these indicators present for us. All right. Now, here's the nice thing about these new indicators and these new setups is you can tune them, and I'll teach you how to do this. You can tune the setups to your own risk tolerance. If you're a very conservative trader, I can show you how to tune it to be a conservative trader. If you like to be a little bit more aggressive, have a little bit more action, I can show you how to tune the setup so that you can get a little bit more action if that's what you like, if that's what you feel comfortable with. Okay? So here's the two new indicators. Like I said, this is a heads-up display indicator. For those of you that don't know, all of our indicators are considered heads-up display, meaning all of the information I talked to you about today isn't in some other indicators, on some other chart, on some other screen, somewhere else. Everything is right where your eyeballs are looking, and we're only giving you information that you can make yes or no decisions from. We're not going to give you histograms or oscillators or wavy lines. We're not going to give you any of that because those give you lots of shades of gray and no black or white yes or no. All of our indicators will give you a yes or no type signal. So this is obviously yes, this condition exists. All right. So what we're doing is we're measuring volume relative to the previous X bars, okay, user definable bars. And if volume is greater than X percent over that percentage, then we're going to print a signal. Okay, so that's our volume, our climactic volume indicator. So let's take an example so you understand what it's doing. So let's say the settings inside the parameter settings of the indicator says the look back equals 5 bars. And let's say the percentage threshold is 200. So what we're saying is we want a signal every time the current bar is 200% more than the average of the last 5 bars. So say we have 5 bars, the total volume is 495. We divide that by 5, we get a 99 bar average over the last 5 bars. The current bar has a volume of 250. So that's obviously more than 200% of the average of the previous 5 bars. That's going to be considered climactic volume. All right, so it's all relative. Now, many of you know, I've been working on this setup for about 2 weeks. No, I'm just kidding. For those of you in the trade room, you know that was an inside joke. I always tell people that things take 2 weeks. It's only going to be 2 weeks. I promise. In 2 weeks, I'll have it ready in 2 weeks. So it's been going on for several months. Because it takes a long time and a lot of points of data to actually find a trade setup that I will put my money on. So as I did that, I started noticing that as I'm looking at and watching the videos and doing them in replay, I'm noticing that when there is a very whippy bar, meaning that there's a lot of wick on a bar, that if we had a potential trade setup with the climactic volume and the bar was particularly whippy that had that climactic volume on it, we didn't necessarily have very good odds of it doing what we expect it to do. Okay, so as I started noticing that, I started thinking, well, people aren't going to know what whippy is. They aren't going to necessarily see that this might be considered a whippy bar because the bar is actually X percentage of this bar is wicks. All right, so we want to exclude these bars from a potential trade setup. So what this would be is we would have this climactic volume, yes, but look how whippy this bar is. So because it's got so much whip in it, you know, and when I say whip, that just means price bouncing back and forth, back and forth, back and forth. We're going to paint the behind the wicks red. And that's going to give us an easy yes or no decision. Okay, on the open of the next bar, if this is red, no trade. Simple, yes, no. All right. So that's a quick introduction to those 2 indicators. And I'm going to show you on Saturday how to use them to start placing trades that we're now going to call, for those of you that know the speed tick trade setup, this has created a naked speed tick trade setup. Okay, we are now going to be able to take some speed tick trades without support and resistance behind the trade. Okay, and I'll show you how we're going to do that on Saturday. No, they're in the, I have the trade room settings are in the documentation wiki. I think it's 300. I was just using 200 as an example. I think we've got it set to 300 right now. Now, of course, that's all tunable over time. But the higher the percentage, the more sensitive it's going to be. The lower the percentage, the more signals you're going to get. So I wanted it to be really kind of sensitive. At least for now. You could certainly make it less sensitive. All right, so some real-time examples. Let's see. No, I can't, but I can on Saturday. I haven't put those together yet, Steve, but I will for Saturday. Yeah, tick charts are fine. You can use these on Rinkos, but I don't know why anybody would. They will work. They will generate signals, and maybe you could find a way to use them. But I don't like charts that remove time. Time is too important, especially as it relates to volume. So whenever you're talking volume, you can't exclude time. So so yeah, I mean you could use them, but yeah, tick charts are pretty close to time charts if you're using a really fast tick chart. All right, so where's Connor? Connor, can you put that link in for the special offer? Can you put that in the chat? There you go. So for those of you that are here, go ahead and click on that, and we've got a really good special. Okay, so ordinarily for this bundle, because we've got these two coming out, and they kind of work together for taking the climactic volume trade, what we're calling our naked speed tick. They kind of work together. I think most people are going to want to get them together. So we kind of bundled them. And if you get it on off our website at $640, if you get it before the 24th of this month, it's $512. But if you get it before the 8th, it's only $410 for both of them. Okay, so we're looking to sell a bunch of these real quick. We're expecting a lot of people to take advantage of this because it's going to be a real help to add more setups to what you're already doing if you're trading with us. Now, obviously, these are going to be inside our Einstein package. For those of you that don't know it, our Einstein bundle package is basically everything we have, everything we'll ever have as it relates to what we do in the trade room and training. And we have training programs, we have mentoring sessions, we have peer mentoring program, we have pretty much the whole everything is part of our Einstein program. And so far, right now, these two indicators will also be in the Einstein, and we haven't raised the price of the Einstein yet. I expect we're going to get around to that next week. But that Einstein price will go up, and it's going to go up by at least $400. But it's basically a one and done. You don't. There's nothing else to buy after you're at Einstein. All right. So you can take a. Thank you, Casey. You can take a look. Yeah, we're always looking at adding more things to give it more value. As of today, Heinz, they are released. As of this that link right there, that's what you need. Now, the VIPs, Einsteins and VIPs, send Connor an email, and he'll get you guys hooked up with the licensing. Okay, you have to get a license. You're not automatically licensed because we have too many people. So you have to request a license. Yeah, Dino, Saturday. I'll show you Saturday the live examples. I have a lot of them. I don't have any on me right now. They're on my other computer. But Saturday, I'll give you all of that. And if you can't make it on Saturday, you will definitely get a video. Okay? So those of you that are already have our packages, you already know a lot about what we're doing here, and this should be a pretty straightforward. We're going to be taking a lot of these trades, so it should be pretty straightforward. And just get Connor, if you're Einstein or VIP already, get Connor your machine ID, and he'll get you licensed and make sure you get the downloads. Yeah, they're in the members area. They've already been added to the members area under the NinjaTrader 8 downloads. All right, so that's all you got to do if you're already a member, already an Einstein. You get it for free. Both of them. Now the wiki for the Wix percent is not complete yet. I'll finish that in the next day or two, and then we'll go from there. Any other questions? Just NinjaTrader 8. We don't develop for 7 anymore, Gary. It's an old, dried up platform now. I say dried up. No, we haven't developed for 7 in a long time, and we still have some indicators for 7, but we don't really support them anymore because 7 is so old. All right, Mike. Nice to see you again. Nice to hear from you again. I hope things are going well. So you can send your requests to support at theintentionaltrader.com. Chris, is your speakers on? Your speakers are on, right? You can hear me? No, Chris Kassouf. Chris Kassouf, can you hear me? Oh, yeah. Okay. Well, yeah, I already mentioned a few times that I would have some on Saturday. I thought maybe your speakers weren't on because I said it like 3 times. Just one, Barbara, but we do. Didn't want to wait. We do have a 75% off if you want to get for more than one machine. So your second license is a 75% discount. You can hit Connor up on either the chat on the website or send him an email at support@theintentionaltrader.com and he can answer all that stuff for you. All right. You know, except for questions, I think I kept it in of pretty close to 45 minutes, which I don't know. I'm going to call that a success. All right. Well, everybody have a great rest of your day. I look forward to seeing you all on Saturday. We'll dig into the nitty-gritty details. All right. Have a great one. Bye now.